Have you ever thought about going back to work after claiming Social Security, only to stop yourself because you heard someone say, be careful, they'll take your benefits away? If so, you're definitely not alone. In fact, one of the biggest sources of confusion among retirees and people approaching retirement is how working affects Social Security benefits. Some people believe that every dollar they earn will reduce their monthly check. Others assume that once benefits are withheld, the money is gone forever. And then there are those who avoid working altogether because they're afraid of triggering some complicated Social Security rule they don't fully understand. The truth is a lot less scary than the rumors. Today, we're going to walk through the Social Security earnings limit rules for 2026 and answer some of the most common questions retirees ask. More importantly, we're going to talk about what these rules actually mean in real life, because numbers by themselves don't tell the whole story. After all, retirement today looks very different than it did a generation ago. Many people don't retire and completely stop working. Instead, they transition into part-time work, consulting, seasonal employment, or even small businesses. Some work because they enjoy staying active. Others work because rising costs have made additional income helpful. And many simply want the flexibility to earn extra money without feeling like they're being punished for it. That's why understanding these rules matters. A misunderstanding could lead someone to make a costly decision. It could cause a person to claim benefits too early, delay work they enjoy, or worry unnecessarily about income that may not even count toward the earnings limit in the first place. So let's clear up the confusion. Before we get into the actual numbers, there are two important foundations you need to understand. First, the rules we're discussing today apply specifically to Social Security retirement benefits. That's important because many people accidentally mix together Social Security retirement benefits, Social Security disability insurance, and supplemental security income. While those programs are all administered by the Social Security Administration, they operate under very different rules. If you're receiving disability benefits or SSI, today's discussion doesn't apply to you. Those programs have their own separate income and eligibility requirements. The second thing you need to know is that the earnings limit only matters if you have not yet reached your full retirement age. Once you reach full retirement age, the earnings limit essentially disappears. You can earn $10,000, $50,000, $100,000, or even more, and your Social Security retirement benefits will not be reduced because of earned income. That's why knowing your full retirement age is so important. Many people assume it's simply age 65, but that's no longer the case. For those born in 1954 or earlier, full retirement age is 66. After that, the age gradually increases by 2 months for each birth year until it eventually reaches age 67 for anyone born in 1960 or later. For now, under current law, age 67 remains the full retirement age for younger retirees. And that distinction matters because once you cross that milestone, the earnings test no longer applies. Now let's talk about the actual 2026 earnings limits. If you're receiving Social Security retirement benefits before reaching full retirement age and you earn more than $24,480 during 2026, the Social Security Administration will withhold benefits. Specifically, they will withhold $1 in benefits for every $2 you earn above that limit. At first glance, that sounds harsh. When people hear that rule for the first time, they often think, wait a minute, are they taking half of everything I earn? Not exactly. They're not taxing your earnings. They're adjusting your Social Security benefits because you're receiving benefits before full retirement age while continuing to earn income from work. There's a big difference. Now, there's also an important exception. If 2026 happens to be the year you reach full retirement age, the rules become much more generous. Instead of the standard earnings limit, you'll be allowed to earn up to $65,160 before benefits are reduced. And even when you exceed that higher amount, the withholding formula becomes less severe. Rather than withholding $1 for every $2 over the limit, The administration withholds $1 for every $3 over the limit. That's a significant improvement and reflects the fact that you're approaching the point where the earnings test disappears altogether. Now, hearing these numbers is one thing. Understanding how they apply to your personal situation is something else entirely. That's where many of the questions begin. One of the most common questions comes from married couples. And honestly, it's a reasonable question because married couples spend most of their financial lives thinking about household income rather than individual income. When you file taxes jointly, both spouses' earnings are combined. When you're budgeting for retirement, you usually look at household cash flow. When you're calculating expenses, you're typically thinking as a team. So naturally, people ask, does Social Security look at my income alone, or do they combine my spouse's income too? Fortunately, the answer is relatively straightforward. The earnings test is based on individual earnings. That means the Social Security Administration looks at your earnings, not your household income. Let's say you're receiving Social Security benefits and earning very little income, while your spouse decides to return to work and earns a substantial salary. Your spouse's earnings alone will not cause your benefits to be reduced. Likewise, if your spouse earns well above the earnings limit, that doesn't automatically impact your retirement benefit based on your own work record. This distinction provides important protection for married couples. Each person's earnings are evaluated separately. However, this is where things get a little more complicated. Social Security benefits aren't always based solely on your own work record. Sometimes another person is collecting benefits connected to your earnings history. For example, a spouse may be receiving a spousal benefit based on your work record. A child may be receiving dependent benefits based on your earnings history. In situations like those, your earnings can affect more than just your own benefit. Imagine you're collecting Social Security early and decide to return to work. If your earnings exceed the limit and your benefits are suspended, benefits being paid from your record may also be affected. In other words, your decision to work could impact benefits being received by a spouse or dependent child who qualifies through your earnings history. This is one of those details that surprises many families. They assume each benefit operates independently. But in reality, certain benefits remain connected to the worker's record. Fortunately, there is one notable exception. Former spouses are treated differently. If an ex-spouse is receiving benefits based on your work record, your earnings generally do not affect their benefits. Similarly, if you're receiving benefits based on a former spouse's record, their decision to return to work won't suddenly interrupt your payments. That's an important protection built into the system, and one that often provides peace of mind for divorced retirees. Now let's move to another question that creates a tremendous amount of anxiety. What happens to benefits that are withheld? This may be the single biggest misunderstanding surrounding the earnings test. Many retirees believe that once benefits are withheld, the money simply disappears forever. They picture it as a permanent penalty. But that's not actually how the system works. When benefits are withheld because of excess earnings, the Social Security Administration keeps track of those months. Then, once you reach full retirement age, they perform an adjustment to your benefit calculation. In simple terms, they recognize that you did not receive benefits during those withheld months, and because you didn't receive those payments, those months don't permanently count against you in the same way early claiming normally would. Think about it this way. When you claim Social Security before full retirement age, your monthly benefit is reduced because you're expected to receive payments for a longer period of time. That's the trade-off. You get money sooner, but your monthly check is smaller. However, if benefits are withheld due to excess earnings, you didn't actually receive those payments. As a result, once you reach full retirement age, the Social Security Administration recalculates part of your reduction and credits back some of what was previously reduced. In many cases, your future monthly benefit increases. That doesn't mean every withheld dollar comes back immediately in a lump sum, but it does mean the money isn't simply lost forever. which is a crucial distinction many retirees never fully understand. Let's put that into a real world example because this is where the concept starts making sense. Imagine someone files for Social Security at age 62. Their full retirement age is 67, meaning they claimed benefits 60 months early. Because they filed early, their monthly benefit is permanently reduced compared to what they would have received at full retirement age. Now, suppose that 2 years later, they decide to return to work. Their earnings exceed the annual limit, and as a result, the Social Security Administration withholds several months of benefits. At first, it feels frustrating. After all, nobody likes seeing payments stop. But what many people don't realize is that those withheld months are essentially being recorded. When full retirement age arrives, the Social Security Administration reviews the situation and adjusts the benefit calculation accordingly. That's why it's dangerous to think of the earnings limit as a penalty. A penalty is something you lose forever. The earnings test is more accurately described as a temporary withholding mechanism. And understanding that difference can completely change how you view the decision to work. In fact, many retirees discover that earning additional income from a part-time job more than offsets the temporary withholding of benefits. That's especially true when the work provides personal fulfillment, social engagement, or financial flexibility. Now let's talk about how the withholding process actually works, because many people imagine Social Security reducing every monthly payment little by little throughout the year. In reality, that's usually not what happens. The administration generally withholds entire monthly checks until the required withholding amount has been satisfied. Let's look at an example. Suppose you're receiving a monthly Social Security benefit of $2,000. You take on part-time work and end up earning enough to exceed the annual earnings limit by $10,000. Under the standard rule, benefits are reduced by $1 for every $2 over the limit. That means Social Security would need to withhold $5,000 in benefits. Rather than reducing each monthly check by a few $100s, the administration may simply withhold several months of payments altogether. In this example, they could withhold January, February, and part of March, depending on the exact calculations. Then, once the required withholding amount has been met, your regular monthly checks resume. This catches many people off guard because they're expecting smaller checks, not missing checks. That's why understanding the mechanics ahead of time can help prevent unnecessary panic. Imagine checking your bank account and suddenly realizing your Social Security deposit didn't arrive. If you weren't expecting it, that could be incredibly stressful. But if you understand how the earnings test works, you'll know exactly what's happening and why. Another question that comes up constantly is whether you should proactively notify the Social Security Administration if you're going to exceed the earnings limit. My view on this is fairly simple. Yes. If you know your earnings are going to exceed the limit, it's generally wise to report it. Now, I understand why some people hesitate. Nobody enjoys making a phone call that could potentially reduce their benefits. There's a temptation to think, maybe I'll just wait and see what happens. But that's often where trouble begins. The Social Security Administration eventually receives earnings information. When they discover that someone received benefits they shouldn't have received, they create what's known as an overpayment. And overpayments can become incredibly frustrating to resolve. The challenge is that these situations don't always get caught immediately. Sometimes the notification arrives years later. Imagine receiving a letter 3, 4, or even 5 years down the road, informing you that you've been overpaid benefits and now owe money back. At that point, records may be harder to locate, memories may be fuzzy, and the situation becomes much more difficult to untangle. That's why proactive communication is usually the safer route. It may not be fun, it may result in benefits being withheld sooner, but it often prevents a much larger headache later. And when it comes to retirement planning, avoiding unpleasant surprises is usually worth a great deal. Now let's discuss another area that creates confusion: the monthly earnings test. Most people hear about the annual earnings limit and assume that's the only rule that matters. But Social Security recognizes that retirement doesn't always happen neatly on January 1st. Life isn't that simple. Many people spend part of the year working and then retire later in the year. Others leave one job, take a break, and begin collecting benefits midway through the year. Without special rules, these individuals could be unfairly penalized because their earlier earnings might push them over the annual limit before they even start receiving benefits. To address this issue, Social Security created what's known as the monthly earnings test. This rule is particularly important during the first year someone receives benefits. Here's a practical example. Imagine someone works full-time from January through June and earns a substantial salary. Then they retire in July and file for Social Security benefits. If the annual earnings limit were applied rigidly, their first 6 months of earnings could prevent them from receiving benefits for much of the remainder of the year. That wouldn't make much sense because they're no longer working at the same level. The monthly earnings test helps solve that problem. During certain situations in the first year of retirement, Social Security evaluates earnings month by month rather than looking solely at the annual total. This allows people who have genuinely retired or significantly reduced their work to begin receiving benefits, even if earlier earnings were relatively high. For many retirees, this rule becomes the bridge between a working career and full retirement. And while the details can become technical, the underlying purpose is actually very reasonable. The system is attempting to recognize that income patterns often change dramatically during retirement transitions. Now let's revisit a topic we touched on earlier because it's incredibly important for families. Will your earnings affect benefits being paid to a spouse or child? The answer depends on how those benefits are being paid. If a spouse or child is receiving benefits directly from your work record, then yes, your excess earnings can affect those payments. Think about the Social Security record as the foundation supporting those benefits. If your benefits are suspended because of excess earnings, benefits flowing from that same record may also be suspended. For some families, this can have a significant impact. Imagine a retired worker who decides to return to work without fully understanding the earnings test. Not only could their own benefit be affected, but benefits being paid to a spouse or dependent child could also be interrupted. That's why it's important to evaluate the entire household picture before making decisions. The exception, once again, involves former spouses. Benefits paid to an ex-spouse generally remain protected from the worker's earnings activity. This distinction often surprises people, but it's a long-standing feature of Social Security rules. Now we've arrived at what is probably the most frequently asked question of all. What actually counts as earnings? If you've spent any time researching Social Security online, you've probably seen endless debates about this topic. Someone asks whether pension income counts. Someone else asks about stock dividends. Another person wonders about rental property income. And before long, the conversation becomes a confusing mix of opinions and assumptions. Fortunately, the answer is simpler than many people think. The earnings test primarily focuses on earned income. In other words, income generated through work. For most people, that means wages from employment. If you work for an employer and receive a paycheck, those wages count. If you're self-employed, your net earnings from self-employment generally count. Those are the primary categories Social Security examines. On the other hand, many common retirement income sources do not count toward the earnings limit. For example, pension payments typically don't count. Most annuity income doesn't count. Withdrawals from IRAs and other retirement accounts generally don't count. Interest income usually doesn't count. Dividend income generally doesn't count. Capital gains from investments typically don't count either. This distinction is incredibly important because many retirees have multiple income streams. A person might receive Social Security benefits, withdraw money from an IRA, collect pension payments, and receive dividends from investments. None of those income sources automatically trigger the earnings test. What matters is whether the income comes from active work. That's a huge difference. And for many retirees, it's reassuring to know they can access retirement savings without creating problems under the earnings limit. Of course, self-employment can introduce additional complexity. The Social Security Administration sometimes looks beyond simple income figures and examines factors such as services performed, time devoted to the business, and other circumstances. That's particularly true during the first year of retirement. So if you're self-employed, it may be worth seeking professional guidance to ensure you're interpreting the rules correctly. At the end of the day, the earnings limit is one of the most misunderstood aspects of Social Security. People hear snippets of information from friends, neighbors, online forums, or social media posts, and often walk away with the impression that working automatically destroys their benefits. But that's not really what the rules say. The system is more nuanced than that. Yes, benefits can be withheld if you earn above certain limits before full retirement age. Yes, those rules can affect spouses and children receiving benefits from your record. And yes, it's important to understand how reporting requirements work, but it's equally important to remember what doesn't happen. The government isn't permanently confiscating every withheld dollar. Your retirement accounts aren't automatically counted as earnings. And once you reach full retirement age, the earnings limit disappears entirely. Understanding those facts can help you make smarter decisions and avoid unnecessary fear. Retirement should be a season of flexibility and opportunity. Whether you choose to work because you need the income, enjoy the activity, or simply want to stay engaged, the key is understanding the rules well enough to make informed decisions. Knowledge creates confidence. And when it comes to Social Security, confidence may be one of the most valuable retirement assets you can have.